Hello everyone, I'm Asta Khurana and welcome to Zerodha Varsity Videos. This is episode 4 of the series Crash Course on Warren Buffett's letters to his shareholders. In the previous video, we talked about a lot of his investments. We talked about why he criticizes auditors and investment bankers, despite the fact that he himself was invested in one. We talked about junk bonds. And in the end, we summarized this video by talking about 25 years highlights of Berkshire Hathaway. In this video, we are going to talk about the letters from the year 1992 to 1996. And for that, I have with me Vineet and Satya from Team Varsity. Let's begin. So Vineet, we have reached to episode 4 and I couldn't resist but to see what is the stock price of Berkshire Hathaway. And I was shocked because I saw that the price, one unit, is for $590,000, which if I talk about in Indian terms, is more than 5 crore rupees. And in India, the stock which is of the highest price is MRF, which is more than 1 lakh. But that is also not the surprising fact. The surprising fact goes back to 1992 because that is when Berkshire Hathaway's price, the stock price was somewhere around $10,000, which was around 2.5 lakhs at the time, and we have not reached that benchmark yet.
In fact, Astha, when I had started reading these letters, I had also checked the price and it was around $520,000. And now you're telling me it's $590,000. Man, Berkshire Hathaway is galloping.
This is true.
Guys, but whenever we look at numbers, absolute numbers, we also should look at the CAGR numbers. So I've seen how the Berkshire Hathaway prices have moved since 1992 to 2023. The CAGR figure is 14 to 15%. So for the last 31 years, it has given per annum 14 to 15%. So whenever we are looking at performance of one stock, we always usually see the performance of the benchmark. In the US, one of the benchmark indices is S&P 500 index. So that particular index in the last same period, 31 years, has given about 8.25% or something like that. Even if we add dividend yield of about 2% on an average, it would have been around 10.25%. So even then there is a alpha, which is excess over the benchmark of about 4 to 5%. Of course, this alpha has come down in the future years, as we move towards the later years of Berkshire Hathaway life. But we'll discuss about it later.
Okay, but then while we are talking about Berkshire Hathaway and such a big price that it has attached to it, Vineet, what I want to understand is, in the previous episode we talked about that Berkshire Hathaway does not give out dividends. They did that only once. And which generally means that whosoever is the investor for Berkshire Hathaway, their wealth is increasing on paper. But despite that fact, Berkshire Hathaway is not doing stock splits. Why is that?
Now, just like you asked, a lot of investors would raise similar concerns. They would keep asking him to split the stock. He had multiple reasons. Let's talk of the 2 highlights. Firstly, if you're an investor and you want to invest in Berkshire Hathaway, the only reason why you're not investing is because of the share price. Basically, you will invest only when the share price splits. You want to invest in a stock for non-value reasons. Warren thinks you will also exit the stock for non-value reasons. Now he's saying, why would he want his long-term investors to sell it to you and have with him the shareholders that are traders? Why would he want short-term shareholders with him? And the second problem is that if the price point of these shares came down to a more affordable number, the brokers would have it on their trade list. They would call their investors and tell them that this is a hot stock, please buy it. Oh, this is a dead stock, please sell it. He does not want that kind of a manic depressive behavior. He does not want that kind of volatility in Berkshire's shares. So he does not want to split. However, he does take an alternative route to splits.
Oh really? He did? And what was that?
Well, that was in the year 1996. We have just begun the episode. Let's discuss that towards the end of the episode.
You always keep good things towards the end of the episode, but in the beginning, we always set the tone of the episode by discussing about what was the economic time at the time and what are we going to talk about in this video. One thing I know, what else is there?
So the period we are discussing is 92 to 96. We had seen in the late 70s that inflation was very high, around 15-16%. Now inflation has come down. Interest rates have also come down to 6-7%. This is the time when technology is booming. A lot of popular stocks of the time, Microsoft, Qualcomm, Apple, are still around. A lot of them died away. Internet stocks were booming. Any company with .com in their name was skyrocketing. Also, rapid industrialization in Asia, specifically China, was moving manufacturing away to Asian countries. And this is also when index funds are becoming all the rage.
Nice. And what do we are going to discuss in this video? So what was happening within Berkshire Hathaway and what, he had to tell to his shareholders?
So let's talk of the agenda. Of course, we'll talk about the investments that he made around the time. Warren Buffett's views on diversification, risk management, and beta. We'll also discuss his views on growth versus value investing. And lastly, the alternative to stock splits.
This is really, really interesting. So let's hop on to the very first thing that we are going to discuss, that is investments. Since the economic time was really amazing as you described, so where was he investing in that time period?
So at this time, Warren is now becoming more structured in the way he's presenting his investments. He's saying any investment which is worth more than $100 million for Berkshire Hathaway, he's listing them as his long-term or forever kind of investments. In the previous episode, we saw that mainly those were GEICO, Washington Post, and Cap Cities. He's adding a few more to this list around this time. That is Coca-Cola, Gillette, and Federal Home Loan Mortgage, that is Freddie Mac, and a few more.
Okay. Vineet, as you mentioned about GEICO, I know GEICO is a very important part of Berkshire Hathaway. That is why you keep bringing up in every episode. So what was so special about GEICO that he is mentioning, in this time period?
Well, the special thing is, I think Satya, you would know, that Warren first invested in GEICO when he was just 19 years old.
Yeah, it's a very interesting story. He invested in GEICO at the age of 19. In fact, he calls GEICO his favorite child. We all know how Warren loves reading books, right? Once he bought this book called The Intelligent Investor. We all know it's authored by Ben Graham. He fell in love with the book. He read the book again and again. He would have read that book almost a dozen times. He went on to become the student of Ben Graham in a Columbia University. And one Saturday, he went to the library and he figured out that Ben Graham was the promoter of one of the insurance companies, GEICO. On that Saturday afternoon, he took a train, went to Washington to understand the business. After going there, he realized that the office was closed. He pounced on the door. He met an executive who helped him understand the insurance business and especially GEICO. Warren later went on to say that David's son, had no reason to tell him or explain to him all the doubts that he had about the insurance business. When he said he was the student of Ben Graham, he took almost 4 to 5 hours to clear all his queries about the insurance. He said that it is a life-changing moment for him in the investment career. The next Monday, he went and he sold almost 75% worth of his portfolio to buy GEICO shares. But Ben Graham, who also believes in the concept of diversification, did not approve of Warren buying GEICO stock, which is now 75% of his portfolio because of the concentration risk. A few years later, Buffett sold the stock, making good profits.
Nice.
Now, carrying that forward, almost 30 years later, GEICO was in deep trouble. And the stock price had pummeled to almost the level that he had bought when he was 19 years old. He offered to rescue GEICO by picking 33% stake in it. Now, that was 1970s. Since then, the operations had revived, and Warren often kept on saying through his letters that GEICO was a better run insurance business than his own operations. And through all of this, GEICO kept buying back its shares. And Warren held on to what he had invested. So his 33% had now become almost 50%. He bought the remaining 50% and now became a fully owned subsidiary of Berkshire Hathaway in 1995.
That is nice. GEICO always has an amazing story to tell with every episode that we are moving forward. But beneath this is some investment of his that we are talking from previous 2 episodes now. And this is an amazing economic time. So what was his new investment in this time?
It was American Express, or Amex. But Astha, even that was not a new investment in conventional terms, because like GEICO, Warren had invested in American Express in the late 50s or early 60s when he was running the Buffett partnership. At that time, someone had defrauded American Express to the tune of almost $160 million. They were standing to lose that kind of an amount, and the stock plummeted. Warren saw an opportunity. He saw that American Express had a very loyal and strong customer base, and they had a very robust balance sheet. Even if they had to pay this entire $160 million in losses, they could still come back standing strong. So Warren picked a stake. And there were, of course, arbitrations going on In the end, American Express ended up paying $60 million. And a few years later, finally, Warren Buffett exited American Express at a 500% profit. Now, if it was such a great investment, why did he exit it? Because he was still following Ben Graham's cigar butt investing. He hadn't even met Charlie around the time, or Charlie's long-term earnings prospect kind of an approach hadn't yet rubbed off on him.
You know, I am wondering that what if he would have met Charlie, or if not met Charlie, at least he had that kind of mindset the way Charlie has, and he must have held on to American Express. American Express would have become another feather to his cap, I must say.
Well, that's hindsight wisdom.
Right.
Yeah, how many kinds of businesses, right? As you said in the previous episode, he was invested in a business with which is producing prison guard uniforms, encyclopedia, kitchenware, pump business, shoe business, whatnot. When he was talking about the shoe business, he referred that a few years ago we didn't think that we would be investing in a shoe business. Now we are singing that there is no business like a shoe business, and I'm driving to work. Warren Buffett was informing his shareholders through his letters that they don't have any view on what kind of business or what kind of industry they would be investing in the future. All that they will be looking at is the economic prospects of the business and how competent the management is. If they find both of these things in one company, and if they are lucky to find that company, they would be investing in that company.
Warren had a very different structure of how he wanted to go about his investments, and the number of investments that Satya has named, it is, of course they are part of the investments, but we also have, other than that, our media business, insurance business to add on to. I am just wondering how many businesses or how many investments this man is going to make.
Well, he's saying he can manage as many managers as they can come. He's saying if there's just one manager and he's a lemon, then that's too much for him. But if there are too many managers and all are competent, like the ones he has had so far, he can have unlimited number of people reporting to him. Now, this reminds me our college curriculum, where you talk about span of management. It is a number of people a manager can efficiently manage under him or her. That number would generally be 6 to 8. Warren is saying that could be unlimited for him.
Well, that is Warren. There are a lot of investments that we have discussed so far, and the fact that I like is that how well diversified Berkshire Hathaway's portfolio is and how well Warren Buffett is managing its risk.
Well, the academicians and analysts of the time thought that Warren Buffett was not adequately diversified in his investments.
Okay.
But Satya, why don't we first explain what diversification conventionally means?
Diversification means creating a portfolio with various kinds of investments, like we have equity, debt, gold, etc. And even within each asset class, diversification looks into investing in more number of securities so that exposure to one single asset comes down.
Now let's judge Warren's portfolio as per this definition. Berkshire Hathaway was mainly invested in equity and debt, so there was not adequate diversification. As far as within equity sector diversification was concerned, they were not invested in real estate, technology, services, utility, etc. So yes, conventionally, they were not exactly diversified. But Warren is saying, why do you need diversification? To manage risk. He's saying that we apply adequate research, we evaluate the company, we see whether it has good economic characteristics and whether they will play out in the future. They have good management in place. So they're doing their due diligence, they're doing enough evaluation before investing in this company. Only when they see that this company has adequate margin of safety that they can earn, will they invest in it. So essentially, yes, they have concentrated their bets in a few stocks, but they're all safe stocks according to Warren Buffett. So he does not need diversification as a tool to manage risk. Now, retail investors need diversification because they may not have that kind of acumen to research businesses, to research the stocks, which is why they have to diversify. Now, Warren is saying the way retail investors use diversification is they are trying to diversify only the price risk by using beta. Now, let's first understand what beta is.
Yeah. A beta, on a definition terms, it sounds a bit technical, like using the covariance, variance, etc. But what it generally means is it's a measure of the risk or volatility of a stock against the market. Say suppose if the beta of a stock is 1, that means the stock has a volatility equal to the market. If the beta is more than 1, it has a volatility that is higher than the market. If the beta is less than 1, it means that the stock has a volatility or a risk that is lower than the market. This is what the definition means.
Okay, so let's put that in example. Say the beta of a particular stock is 1.5. So if the market goes up by 1%, the stock will rally by 1.5%. And if the market goes down by 1%, then that stock will go down by 1.5%.
Exactly. Now, here beta is only looking at the stock's price risk. It's not accounting for the business risk. Warren is saying that when he invested in Washington Post, it had fallen down considerably. So the beta looked much higher, the stock looked much riskier. But Warren had studied the management, Warren had studied the business. He knew that it was a good investment because he studied the business and not the price. So he invested in it. If you look at the price, the stock's beta was high, meaning the investment was risky. But when you look at the business, it was a safe business. It was a good business to invest in. That is why Warren is saying that beta may not be an adequate measure of risk. What you should be looking at is the real risk of the business. But again, if you do not have that kind of acumen or time resources, you should just diversify across multiple investments, and that is how you manage the risk in your portfolio.
Now, a small trivia here, guys. So Warren said that he doesn't want to dabble with so many stocks and want to stick to and focus on very, very few number of stocks. That's because he was giving size as the issue, because as the capital of the Berkshire Hathaway grew, he found it really difficult to make many smart decisions. They want to make only a few smart decisions and then focus on it. In fact, Warren and Charlie decided that they'll stick to only one idea per year. That's when Charlie would say, this year it's my turn.
But that was just a policy. They never followed up on it, because in the subsequent years only, they went on to acquire 2 businesses, 6 businesses, and even 8 businesses in a given year.
My God, the type of, the way they are doing investments and the way Warren is talking about how they understand the meaning of diversification and how they are managing their risk, it seems to me as if Warren is a value investor. So what are his views on growth investing?
Well, for him, he said that value investing is a redundant term. What is investing if you're not seeking value in that business? And contrasting to that, he would say growth investing is basically you're paying a price that is higher than the business's intrinsic value, hoping that the price will rise further and you will make a profit on it. He says that's basically speculation. So for him, all investing is value investing and growth investing is speculation.
Okay, but Vineet, for better understanding, can you briefly explain what a value investing and growth investing is?
Sure. So value investing is conventionally looked at as when you invest in a company that has a low PE or low PB ratio, or when you analyze the company, you see that its intrinsic value is much higher than its market value. And growth investing conventionally is when you are investing in a high PE or high PB kind of a business. Usually the business is growing very fast. Profitability may or may not be there in the business.
Okay, so now I understand why Warren Buffett is saying that value investing is investing and why growth investing may be a speculation.
Yes. So he's saying that sometimes a business might grow but not create value. It is possible that a technology company has been galloping in its revenues but is unable to achieve profitability. So they are growing in size, they are growing in assets, but they're not creating value because they do not have profits for the shareholders.
Typically in the mainstream, we look at, as you said, low PE, low price to book ratio, or the high dividend yield as the characteristics of a value stock. Warren Buffett says that it may not be the characteristics even combined, even if all the terms or all the metrics are ticked, it may not be a value stock. Similarly, on contrast, even if it's a high PE, low dividend yield, high price to book ratio doesn't mean it's not a value stock. So instead of looking at whether it is a value stock or a growth stock, what Warren would see is we all know, he always looks at the intrinsic value of the business. And of course, when we calculate the intrinsic value of the business, even if we are taking the same numbers or looking at the same company, the intrinsic value for you could be different and the intrinsic value that I calculate could be different. So to reduce the error while calculating the intrinsic value of the business, he considers 2 things. One, he looks at businesses that he understands, simple businesses that he understands. It's just reiteration of the points that we discussed over the episodes. That's the first. And the second is the 3 important words that he always keeps referring to, the Ben Graham's margin of safety. To give a definition of what a margin of safety is, again, it's the difference between the stock price and the fair value or the intrinsic value of the business. The higher it is, the better margin of safety that you as a shareholder have on that particular stock.
Nicely concluded, Satya. Guys, before we go ahead, there is this one doubt that I had in my mind when we concluded the previous episode, when you said that size was an issue. But what I want to understand is that he has so many investments, he's managing them very nicely, he knows how to manage risk, and he's giving lessons as well. Despite that fact, why will you say that Berkshire Hathaway as a size was an issue?
Well, let's look at it this way. In early 70s, if they invested in a business that would add 1 million to their earnings, it would overall bump their net profits for the year. But now, if they add a business that's just giving them 1 million in additional earnings, it wouldn't move the needle by even 1% for them. So now he's saying that they are so big by this time that the universe of investable stocks has shrunk for them. Now, to give you an example of how size impacted them, they had invested in Gillette's preference shares. Those were convertible preference shares. And in a year or two, they also got converted to common equity. Around this time, Warren is pointing out that when they had picked up these preference shares in a private placement from the company itself, if a retail investor had picked Gillette's common stock on the same date and held on till Warren is holding it, that retail investor would have made a bigger gain. Warren did make a considerable profit on Gillette investment, but he's saying a retail investor must have made more in percentage terms. Now, this happened because he had to buy preference shares in a private placement. A smaller investor does not have to be bound by such restrictions.
Rich people problems.
I think what you're trying to say here is that when he went on, if he buys that stock in the common market, then the price would rise up quickly because, of course, people are following his investments by now. That is very clear. So he will not get the shares at an attractive price. So he was better off buying a preference share rather than buying it in the common market.
Given the size, he was better off. But yes, when you compare the results, he has to complain about a few points of returns that he did not get.
Now I get why Satya said rich people problems.
Vineet, in this episode, we are discussing about the problems of the size of the company. But remember, in the previous episode, we also discussed about Salomon Brothers. Warren and Charlie invested in the company. The company went into trouble. Warren and Charlie, because of the size that they invested in, because of the stake that they had in the company of its size, they got a board seat. They pulled the company out of the trouble and eventually made good profits.
Yeah, that is right. I mean, you see, in both the examples, he's facing size issues in Gillette, but he is in advantageous position when we are talking about Salomon Brothers. So I think in whatever situation you are, you have pros and cons. And as an investor as well, whatever strategy you are following, you will have pros and cons. So it is okay to be comfortable with the fact, whatever makes sense to you, you should be sticking to that particular bit.
Precisely, and Warren's style was to be invested for the long term. Remember how in the previous episode we spoke of Warren Buffett completing 25 years of running Berkshire Hathaway in 1990? He said that in 2015, that's another 25 years later, he lists down the mistakes that he's made in these 25 years. However, in 1994, he says, well, it's too far and too spaced apart for him to list down all the mistakes. He should update his shareholders in a more real-time manner. So in 1994, he enlists two mistakes. One is selling Capsities too early, and the other is holding on to US Air for a bit too long. Now, Capsities was in fact twice a mistake over. It was in 1978 when Warren had first bought it and sold it in 1980. And at that time also he felt it was a mistake, and he's telling that I don't have words to explain why I sold it. He was a long-term investor. So of course, if he was selling it in just 2 years, he didn't have explanation for it. So
this is so unlike him.
So in 1986, when Capsities was acquiring ABC, ABC was 4 times the size of Capsities. Warren Buffett helped this acquisition by picking up 25% in this newly formed entity. And in 1993, he sold it when Disney acquired Capsities. Only 1 year later, he's saying that the stock price has run up, and because Warren sold it, he has cost the shareholders a loss of $222 million.
Not that the shareholders have not made profit of what investment he had, but like nice owners that he has taken up to himself.
Yes. And then he had also invested in US Air, which was again a convertible preference share. and he had invested about $358 million. He's saying he knew that the airline industry had troubles, but he again believed in the management. And later on, when he's admitting that it was a mistake, he's saying it was perhaps a lapse of judgment. He's holding on to it. This company has stopped giving dividends even on preferred shares, and we don't know what is going to happen of it.
Quoting the textile business, he said that when a good management runs a worst business or the bad business, it's the reputation of the bad business that survives. I think when it comes to airlines industry, I think it's a similar statement that he said, that the reward for the skilled management in the airlines industry is just survival and not prosperity.
Precisely.
I think in both the examples that you have given, talking about cap cities first, it seems as if he jumped off the ship too soon. But in case of US Air, he held on to the sinking ship.
Yes. Now, having admitted to his mistakes, he's also willing to set a target for himself. We know so far that Warren Buffett has delivered about 23% growth per year in Berkshire Hathaway's book value. He's alerting the investors that they should expect a long-term average of just 15%. So these returns would come down. And from the current levels of 1993, he's saying a 15% growth would amount to $1.85 billion in earnings in the year 2000. He's saying in the year 2000, Berkshire Hathaway should make $1.85 billion. If not, Warren and Charlie are basically risking the public embarrassment and admitting to their shareholders that they had painted a target which they could not achieve. Now, this is in direct contrast to other CEOs and managers who Warren Buffett is again criticizing. These CEOs or managers would give guidelines for earnings or revenues over the next quarter or the next year. He's saying, why were they so hard-pressed about these short-term movements is because that is how their bonus would be decided. Of course, they had to justify their bonus. However, these CEOs would not give long-term targets. And if something turned out well, they would say, see, over the past 3 years or 5 years, we've given such high, such strong returns. Basically, they were shooting in the dark and painting a target afterwards. Warren is saying, with my target of 2000, I am painting the target now and hoping to get the aim correct.
Okay, Vineet, you said that the target for year 2000 is $1.8 billion. So just asking for me, did they achieve it?
It's not the year 2000 that we're discussing. No, Astha, we'll discuss it when we discuss that year.
Nice. Vineet, we have come so far in the video and yet we have not talked about the alternative of the stock split. Why don't you say it now?
Sure. Now let's look at the build-up of what led to this alternative to stock split.
Okay.
They were really big in size. Warren was a very popular investor. A lot of people were following his investment style. They would try to clone their portfolio by replicating whatever stocks Warren or Berkshire Hathaway had invested in. They wanted to invest in Berkshire Hathaway, but the share price had now reached $36,000. Mind you, Astha, when you were talking about 1992, the share price was $10,000. Now it has gone up to $36,000 in only 4 years. Now fund managers spotted an opportunity. They said there are investors who want to invest in Berkshire Hathaway, and Berkshire Hathaway is unaffordable for them. They created unit trusts, which are similar to mutual funds, and some managers applied one strategy, which was take money from the investors and invest it in Berkshire's shares. Now the problem here is liquidity. You will always have to maintain some cash to honor the redemptions. There were another set of fund managers who would invest in the shares that Berkshire Hathaway was investing in. Now the limitation here is that Berkshire Hathaway also had a big portfolio of privately run companies. These were not listed companies. So the performance of these funds was not going to be exactly what Berkshire's performance was.
Right.
However, the investors were lured saying that, see, the past 30 years Berkshire Hathaway has been galloping, giving such great returns. You can have the same returns too. So invest with us and join Berkshire's journey. Now for Warren Buffett, this was kind of defrauding the investors or manipulating innocent investors, and he did not like it happening in his name. So finally he gave in. He introduced an alternative class of shares called the Class B Berkshire Hathaway shares.
Okay, what are Class B shares? Pehle, we need to understand that.
Class B shares in the US are a form of differential voting rights shares in India, the DVR shares. You would have heard about Tata Motors giving DVR shares. It's a separate set of shares. Its prices are different, and also the voting rights for that particular DVR shares are different. So Class B shares in the US are also similar to these DVR shares. Berkshire Hathaway, when it started or when it issued the Class B shares, during that point in time, the Class B share is of the value which is 1 by 30th of the value of the original share or the Class A share. As you said, the Class A share was then valued 36,000. So in that case, the Class B share would be $1,200. Coming to voting rights, which is the main part, where is the difference between Class A and B? Class B shares voting rights were about 1 by 200th of the voting rights of the Class A shares. That means if Class A share has 1:1, right? In the sense, for one share, one voting right. For Class B shares, if you hold 200 shares, then you will have one voting right. It's to maintain, no dilution in the voting rights.
Now, Class A shareholders were also allowed to convert their shares into Class B shares. However, you could not accumulate 30 Class B shares and convert them back to Class A shares. At the time when the issue for Class B came out, Warren Buffett did not have an issue size. He said, we will take all the money that investors have to give us. We will issue as many number of shares as these investors demand. Because if there's an oversubscription, there's a post-IPO anomaly, and Warren did not want that kind of volatility in Berkshire's share prices. Also, at the time of the issue, Berkshire's share price was quite aligned with its intrinsic value. So Warren is saying that Charlie or Warren himself would not invest in Berkshire at the prices that were prevalent at the time. However, if any investor, how much ever they may be, if they want to invest in Berkshire Hathaway, they are welcome to invest. And Warren and Charlie will figure out a way to deploy all the capital that flows in through Class B shares.
Yeah. Wow. Coming to the splitting of shares, Warren and Charlie said that they wouldn't split Class A shares, but they did split Class B shares thrice. And now coming to the Class B shares, the price and the voting rights, the gap only widened over the years. And if you see at today's market price, the price of the Class B shares is 1 by 1,500, that is 1 by 1,500 of the value of the Class A shares. And coming to the voting rights, it is 1 by 10,000 of the voting rights that Class A shares give.
Wow. I mean, this episode we have learned so much about his investments, about his mistakes, and about his, the way he's managing risk. So let me conclude this video. And the very first learning that I have from this video, I have to talk about diversification, because of course the meaning for Berkshire Hathaway and Warren Buffett for diversification is different. But for retail investors, I believe, since if you do not have enough time, resources, so in order to manage risk, diversification is a better tool. And when we were talking about beta, whether using it or not is debatable, but what we need to understand is that if you believe and if you understand the business that it is fundamentally doing good, then you should stick with it.
I liked the growth versus value analogy, that every company in every investment should be value accretive. He says that growth and value are joined at the hip. He always looks at the intrinsic value of the company, and the three important words: margin of safety, margin of safety, margin of safety.
We can say that Warren was a goal-based investor because he painted a target for himself for the year 2000 of $1.85 billion, and he wants to stick to it. As retail investors, we can also have goals as to what kind of risk and returns we are expecting, and that is how we should plan our investments.
Right. And the another thing that I liked in this episode is when Warren is taking up the onus of what mistakes he committed, and he takes the opportunity to educate investors through his mistakes, and that is what I like the most. He is accepting to the fact that he held on to he did not held on to capacities, and he sold it soon. So retail investors, if you think that a business is generating good profits to you, so perhaps jumping on the ship off too soon, you better hold on to it. And if you think that you already are on a sinking ship like the one in case of US Air, then probably it is okay to book losses and switch to better opportunities.
I would highlight the size issue. While in case of the Gillette, Warren had earned or generated a fewer returns than what a retail investor who would have participated in the market would have generated. But in case of Solomon Brothers, only because of their involvement, because of the size that they had invested in the company, they were able to bring out the company from its trouble. Vineet said it to me that whatever it is, maybe the size of the company, everything will have its own pros and cons, and we just have to play to our strengths.
Right.
And what we see from Warren's views on stock splits is that they're generally done to increase trading activity, something that Warren did not like. He only gave in because he did not want people to be tricked in his name.
Wow, so much to learn, and I'm liking how with every successive episode, things are getting more exciting and interesting. So this was all about episode 4. We'll meet you in the next episode. Before we sign off, do tell us in the comment box what were your learnings from this episode. See you. Happy investing.